Good evening, friends. Today we shall discuss on agriculture income. So, the beginning we should know what is mean by agriculture income. Agriculture income is defined under Section 2(1)(a) of the Income Tax Act. As per Section 2, subsection 1(a), agricultural income generally means any rent or revenue derived from land which is situated in India and is used for agricultural purposes. Agricultural income is not taxable under Section 10, subsection 1 of the Income Tax Act, as it is not counted as part of an individual's total income. However, the state government can levy tax on agricultural income if the amount exceeds 5,000 per year. So, what are the taxability or tax treatment of income tax, agricultural income tax? Agricultural income is not taxable under section 10(1) of the Income Tax Act, as it is not counted as part of individual total income. That's what we have already studied. However, the state government can levy tax on agricultural income if the amount exceeds rupees 5,000 per year. So, agriculture income in India is categorized as valid source of income and basically includes income from sources that comprise agricultural land, building on or related to an agricultural land, and commercial produce from an agricultural land. This income is considered for rate purposes while calculating the income tax liability of an individual. So, what is considered as agricultural income? Section 2, subsection 1(a) of the Income Tax Act details out the conditions wherein sources can be considered to be generating agricultural income. The section definitions basically point out the following as the sources for agricultural income. Number 1, revenue generated through rent or lease of a land in India that is used for agricultural purposes. Number 2, revenue generated through the commercial sale of produce gained from an agricultural land. Third, revenue generated through the renting or leasing of buildings in and around the agricultural land subject to the following conditions. Condition number 1, the cultivator or farmer should have occupied the building either through rent or revenue. Number 2, the building is used as a residential place, storeroom or outhouse. Number 3, condition number 3, the agricultural land or the land where the building is located is being assessed for land revenue or subject to a local rate assessed. However, there is some or few exclusion to this income, which are as follows. Number 1, revenue from sale of processed produce of agricultural nature without actual agricultural activity. Revenue generated or sale of processed produce of agricultural nature without actual agricultural activity is excluded. Number 2, revenue from extremely processed produce. Total process is processed produce. Revenue from trees that have sold as timber. Revenue from trees that have been sold as timber are excluded from this income. So these are not agricultural income. So some key points to remember while considering if an income is actually a valid agricultural income. The some key points. Please note. Number 1, income should be from an existent piece of land. Number 2, income should be from a piece of land that is used for agricultural operations. Number 3, income should stem from produce achieved after cultivation of the land. Stem from produce achieved after cultivation of the land. Number 4, income can be from a land that is not under the SSC's ownership. So now these four the key points for considering an income as a valid agricultural income. So now the question arises, is agricultural income taxable? By default, agricultural income is exempted from taxation and not included under total income. The central government cannot impose or levy tax on agriculture income. The exemption clause is mentioned under section 10 subsection 1 of the Income Tax Act of India. However, state governments can charge agricultural tax. As of the latest amendment, income from agriculture, if within INR 5,000 in financial year, will not be accounted for tax purposes. Anything above that will be taxable as per the applicable rates. As per the Finance Act, the total tax liability for a person would include the agricultural income added to non-agricultural portion. Though being exempted from tax through section 10 section 1, tax on agricultural income still persists in state level if the mentioned income exceed INR 5,000 per year, and if the total income excluding agriculture income is more than the basic exemption limit. For farms, non-individuals and companies, it is easier to pay the associated tax as the tax is charged at a flat rate on the chargeable income. For salaried individuals, it might increase the tax they need to pay because the aggregation of income. So there are few agricultural produce which are partly agricultural income and partly non-agricultural. So number one, income from growing and manufacturing of any produce other than tea, rule 7. An SSC may have composite business income which is partially agricultural and partially non-agricultural. For example, where XYZ Limited grows potatoes and further process it to sell as a wafer, in this case the company has composite income, that is from agriculture and from business. Secondly, income from growing and manufacturing rubber, rule 7A. Income derived from the sale of centrifuged latex or Senex or latex based crepes or brown crepes or technically specified block rubbers manufactured or processed from field latex or coagulum obtained from rubber plants grown by the seller in India shall be computed as if it were income derived from business, and 35% of such income shall be deemed to be income liable to tax. In computing such income, an allowance shall be made in respect of cost of planting rubber plants in replacement of plants that have died or become permanently useless in an area already planted, if such area has not previously been abandoned, or for the purpose of determining such cost, no deduction shall be made in respect of the amount of any subsidy which under the provisions of 10/31 is not includable in the total income. So now the third is income from growing and manufacturing of coffee, rule 7B. In case of coffee, income derived from the sale of coffee grown and cured by the seller in India shall be computed as if it were income derived from business, and 25% of such income shall be deemed to be income liable to tax. 25% of such income deemed to be income liable to tax. Number B, income derived from the sale of coffee grown, cured, roasted and grounded by the seller in India with or without mixing chicory or other flavoring ingredients shall be computed as if it were income derived from business, and 40% of such income shall be deemed to be income liable to tax. That means 60% is exempted as agricultural income. Income from growing and manufacturing of tea, rule 8. Where the SSC has a business of growing tea leaves and then processing it or manufacturing the same, the procedure adopted to disaggregate is as under. Number step 1, compute the income of growing as well as manufacturing tea under the head profits and gains of business or profession. After claiming the deduction available under that head, step 2, 60% of the income computed in step 1 will be treated as net agricultural income, and 40% of such income so arrived is treated as business income. So in case of tea manufacturing, 40% of income is business income and 60% is agricultural and hence exempted. So that is so I should note here different the partially agricultural and partially business income one by one. Their rules and agricultural income and business income. Growing and manufacturing tea rule defines 8. Agriculture income 60% and business income 40%. In case of rubber manufacturing business, rule 7A, agriculture income 65% and business income 35%. In case of coffee grown and cured by seller, 7B subsection 1, rule 7B and sub rule 1, agriculture income 75% and business income 25%. In case of coffee grown and cured and roasted, agriculture income is 60% and business income is 40%. This is all related to agriculture income. Full agriculture income totally exempt, and partially business income and partially agriculture income. That's what we have already today discussed. Thank you, and I request all the viewers to subscribe my channel for being updated on different issues related to income tax, the indirect tax, and also GST and all. Thank you for watching the video. Thank you.